Everyone thinks Enron was the worst financial crime in history. It wasn't. It was just the one that got caught. Because today, the biggest frauds on earth don't collapse overnight. They don't make headlines. They don't come with perp walks or prison sentences. They live quietly, inside your retirement account, your pension, your index fund. Perfectly legal, perfectly boring, and perfectly designed so you never question them. No handcuffs, no villains, just slow, invisible theft. The kind that doesn't feel like stealing. The kind that only reveals itself years later, when you finally need the money. If you think your money is safe, this video is about to make you very uncomfortable. So let's rewind. Late 1990s. Energy markets are dull, predictable, regulated. Electricity gets produced, electricity gets delivered. Utilities make steady profits. Nothing exciting. And Enron hated that. Enron asked a dangerous question. What if electricity didn't have to be boring? What if energy could trade like stocks? Not power plants, not cables, not physical reality, but contracts, paper promises, agreements about future prices. They didn't sell electricity, they sold expectations. They turned energy into a casino. You could bet on prices going up, bet on prices going down, bet on weather, bet on shortages that didn't exist yet. And Wall Street loved it, because unlike building power plants, paper profits appear instantly. No waiting, no delays, no reality check, just numbers. Enron called it innovation. Accountants called it mark-to-market, which sounds harmless, almost technical. But here's what it really means. You sign a contract today. The contract might pay out over 10 years, but instead of waiting 10 years, you pretend you already made all the money, today, right now, on paper. Tomorrow's dreams become today's income. And if those dreams come true, great. And if they don't, that's where things get interesting. Losses didn't disappear, they just got hidden. Special purpose entities, off-balance sheet vehicles, shell companies with fancy names, created for one reason only, to take Enron's bad bets off the books. Debt didn't vanish, it just stopped being visible. A financial shell game, so complex that even professionals struggled to follow it. Analysts didn't understand it, regulators didn't question it, auditors signed off on it, because everyone was making money. And in finance, confusion is profitable. Executives cashed out billions, stock prices soared, the logo looked trustworthy, the narrative sounded smart, until reality showed up. And when the illusion collapsed, it wasn't abstract, it wasn't theoretical, it was real people. Employees whose retirement accounts were filled with Enron stock, retirees who believed the numbers, families who thought the system was fair. Their savings evaporated, not because they gambled, but because they trusted. The public reaction was outrage. How did this happen? This can never happen again. So governments responded. New rules, new regulations, new oversight, new promises. And Wall Street nodded politely, because while politicians were fighting the last war, finance was already planning the next one. The next fraud wouldn't use fake companies. It wouldn't rely on secret partnerships. It would use something much more powerful, something completely real, something everyone trusted. But while everyone was outraged at Enron, Wall Street was quietly learning a new trick. And the next fraud would be much, much bigger. Enter the age of financial engineering. Mortgages. Millions of them. Good mortgages, bad mortgages, and mortgages that never should have existed. All dumped into the same pile, mixed together, then sliced into layers. Top layer, safe. Middle layer, moderate. Bottom layer, risky. At least that's what the labels said. Mortgage-backed securities. a machine designed to turn debt into something that looked like gold, as long as housing prices kept rising, and according to Wall Street models, they always would. History disagreed, but the math ignored history. Banks sold these products, rating agencies blessed them, investors bought them. Pension funds, insurance companies, retirement accounts, all chasing safe yield. Then the payments stopped, and the entire structure cracked at once. 2008 wasn't just a crash, it was a mass awakening. Banks didn't know what they owned. Funds didn't know what they held. Nobody trusted anyone. Credit froze. The global economy seized. Governments stepped in. Trillions of dollars deployed. Banks were saved, markets were stabilized. But something important was never repaired: trust. The crash didn't teach the world what it should have. In fact, it taught something far more dangerous: that complexity can hide mistakes or fraud perfectly. Private equity. Not illegal, not secret, just ruthless. Private equity firms don't just buy companies, they buy them using borrowed money, massive amounts of debt. Then they take that debt and put it on the company itself. The company looks profitable. The firm looks smart, because the debt isn't theirs anymore. It's someone else's problem. Then the real work begins. Costs are cut, jobs are eliminated, pensions are restructured. Assets get sold off, factories shut down, community programs vanish, dividends flow to investors at the top. And if the company collapses under the weight of borrowed money, that's just business. Remember Toys R Us? Retail chains, hospitals, entire communities hollowed out. Executives walk away wealthy, workers walk away with nothing. It's legal, it's normalized, and it's fraud by design, not by law. And if you thought Enron or the banks were the end of it, meet the modern illusionists of Silicon Valley. The stakes, even higher. The traps, even slicker. Silicon Valley. The new heroes are disruptors.
They don't build power plants. They don't sell electricity. They sell hope. Elizabeth Holmes promised to revolutionize medicine, raised $900 million, not for a product, not for testing, for a fantasy. She used a deep voice, a black turtleneck, a story about changing the world, and millions believed her. Investors poured money in. She wasn't a CEO, she was a ghost. The result? A $9 billion collapse, all gone. Not from market crashes, not from competition, gone because reality never existed. The lesson? In today's world, you don't need factories, plants, or machinery. You just need followers and a story people want to believe. Technology made one thing clear. You don't need factories or wires to take billions. You just need followers and a story everyone wants to believe. Crypto. A modern Enron, but digital. Sam Bankman-Fried, billionaire on a beanbag chair. The savior of finance, or so it seemed. Behind the FTX logo, a digital trapdoor. Billions of customer dollars transferred into private gambling funds. $8 billion vanished, not lost in a crash, not due to bad bets, just moved, quietly, elegantly, invisible to the outside world. The same special purpose maze Enron used decades ago, reimagined for the blockchain era. Digital money promised freedom, transparency, and innovation, but behind the screens, the patterns were eerily familiar. 1 out of every 10 public companies in the US today is a zombie. They don't make a profit. They can't pay their bills. They only survive by borrowing more money. They are the living dead of the stock market. Ponzi schemes with ticker symbols. And the scariest part? They are sitting inside your index fund right now, waiting for interest rates to rise, waiting for debt to come due, waiting for the moment when the illusion cracks. And when that happens, it won't just be one company failing. It will ripple through pensions, ETFs, and retirement accounts. It's silent, invisible, and legal. Companies that were once frowned upon for stock buybacks are now celebrated for it. They borrow billions, not to grow, not to innovate, but to buy their own shares. Why? Executive bonuses, short-term stock prices rise, long-term value decays, and everyone else left holding the risk. The shadow market of derivatives adds another layer. Hundreds of trillions of dollars in contracts tied to interest rates, currencies, corporate debt, and outcomes no one fully understands. You don't even need to own the underlying asset to bet on its failure. Stability doesn't pay, volatility does. The higher the stakes, the bigger the bonuses. Regulations exist, technically, but regulators rotate into industry jobs. Industries fund political campaigns. Oversight quietly softens. Warnings are labeled pessimism. Whistleblowers are silenced or ignored until something breaks. It always does. Systems built on leverage don't fail gradually. They fail suddenly. One shock, one miscalculation, and the whole structure collapses at once. And the question always comes back, is the system broken? No, it works exactly as intended. It concentrates wealth, it socializes losses, it protects insiders, and it sells risk to the rest of us. Every legal loophole, every obscure financial instrument, every innovative product was designed for one thing: to make the rich richer and everyone else pay for it. This is the reality, not theory, not conspiracy. It's written into the laws, it's approved by accountants, it's blessed by auditors, it's celebrated by markets, and it's hidden in plain sight. So the next time someone tells you your retirement is safe and diversified, remember this: diversification doesn't remove risk, it spreads it. And when everyone owns the same risk, failure doesn't disappear, it synchronizes. And when it hits hard. The lesson of Enron, the mortgage crisis, Silicon Valley, crypto, private equity, zombie companies, buybacks, and derivatives is simple. Complexity hides fraud, innovation hides risk, and legality hides cruelty. The world hasn't learned. The system didn't change, it evolved. And the next collapse isn't a question of if, it's a question of when. So ask yourself, where is your money? Who is managing it? And what illusions are they selling you today that will disappear tomorrow? Because this isn't history repeating itself. This is history continuing. And one day, the quiet theft will catch up. And when it does, everyone will ask the same question again. How did this happen again? It didn't happen again. It never stopped.